Hey guys, welcome to this week's Money and Investing Show. This week we are tackling the rather difficult and thorny subject of industry super risks. Much is said about them being set up in the benefit of their members, which may well be true on some levels, but there's plenty more to discuss in there, as you'll see in this show. Look forward to seeing you on the other side. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Thank you, Mr. Baxter, for having me on the show. To jump straight into things, we're going to talk about something that you absolutely hate. It starts with R and it rhymes with ISK, and it's called risk. Nonetheless, it's going to be applied to industry superfund risk. Sensitive topic, nonetheless, let's break it down.
It's an interesting one, isn't it? And in the past, and I think we still may run it in social, we've run campaigns about how self-managed super can reduce your risk, and people talk, they're almost brainwashed into my industry super did this or that. So it's a huge and very, very emotive subject. But when we look at it through perhaps some more unemotional and objective lenses, sometimes what you think something is versus what it is can be very, very different.
Expectations versus reality. And we see this across the board in financial markets a lot of the time. How would you apply it to industry super?
Okay, is it a diamond or is it a fugazi?
Could be either.
Indeed. So industry super is an interesting one. I mean, obviously, it's a juggernaut of an industry and it plays a very, very important part of the financial world. And I think as an overarching caveat on this, any form of investing is better than no investing. Let's use that as our ground zero. And the fact that industry super provides a catch-all for people to make sure that they have a contribution toward their retirement, I think is something that's extremely important. And on that basis, it's a tick. However, one of the things that we do see from people is the belief, and maybe it's perhaps the marketing or the loyalty within that perhaps industry super is the best vehicle that's there to best serve its members' interests. And there's plenty going on in the environment from a risk perspective that would suggest that could be a problem. If you take CBUS, which is, for example, the super in the construction sector, the investment in construction projects by a super fund that represents people that work in those projects is not only a conflict of interest, but it's probably risk on in that if there's a substantial downturn in property or property development and construction, that can affect the members by them losing their job. Also, it can affect the performance of their investments too. And we've seen a couple of fairly large scale construction companies go under over recent months, and they have had investment from CBUS, for example, as part of their asset base.
It's a good example to kick us off. And if we split up risks with industry super funds into two categories, A, B, let's say regulatory and performance risk. Let's break down each of those. And if we start with regulatory risks, what would the first thing to come to your mind be? Probably
the most recent one. And again, I go back to this notion that industry super is all about serving its members' best interest. And it's the overarching rule, I suppose, within finance is always look after your client's best interest. If we take, say, Host Plus, for example, where they've just introduced a new fee levy for their members, and the purpose for this fee levy, and this beggars belief, is to raise $54 million to be set aside in anticipation of any future fines against the super provider and its director for any misconduct within the market or regulatory issue. Yeah.
That's crazy. So they're taxing their clients to save up money in case they do the wrong thing.
Pretty much, if you want to put it in those terms, yes. And the reason this has come about, there's been various changes in the SIS Act and different legal areas, but one of them is called Section 56 Amendment. And a super fund can't use member money, as in the investment funds, to pay fines. And what that then means is if the super provider doesn't have sufficient capital reserves, it runs the risk, of course, of being insolvent, which from a financial markets or financial services perspective is the most heinous crime, trading whilst insolvent. So instead, they're going to their members and they're going to raise a levy of $54 million from their members in case they break the rules as the manager of that money. It's just extraordinary.
And once that capital is raised, that fee then stops, is that correct?
At this point in time, I'm sure they'll go back and top that up over time as perhaps fines may increase or to keep it in line with inflation, which is running pretty hard. But nonetheless, let's just basically add in a new fee, tax our members, because we act in our members' best interest, just in case we get fined for doing something wrong down the line.
Sort of a capital raising exercise, but probably not the greatest in terms of superfund.
Yeah, you look at the compliance risk on that, and maybe as a director of it, your obligation is to make sure you don't transgress the rules of financial markets and thereby not get fined.
Totally. Any other regulatory risks you see with industry super funds at the moment?
The issue of having to go back to clients and demonstrate performance and underperformance, I think, is a massive breakthrough. And obviously the government have legislated for that, where if you're a superannuation fund and you've underperformed your benchmark, then you do have to go to your investors and say, look, we suck at what we do. We've had a pretty bad year. Or maybe it might be sustained over several years. So if you wanted to leave us, we totally understand. That, I think, is a huge breakthrough because, again, with those default industry supers, and I started the broadcast by saying they play a very, very important role in financial markets and people's well-being. But it can also be like a lazy asset allocation decision. We go, I can't be bothered to go through all of the paperwork and everything that may be involved to change my super provider, so I'll just leave it there. When you get that letter and it says, look, we're actually doing a really poor job of managing your money for your retirement, given the fees that we've charged you, if you want to move somewhere else, you can. That in itself, I think, is a huge breakthrough. And in fact, when that first research report came out, I think it was something like it's either 9 or 11 super funds.
We did a podcast on it.
Yeah, underperformed their benchmark. And the benchmark wasn't the market because their performance targets were actually below market performance anyway. So really quite staggering. But, let's not beat them up. There is a role that they play. But that notion of charging your members in case your directors and the people operating the fund transgress and break the rules and incur a regulatory fine, you can then use that money to pay for it, is just incredible.
Crazy. So to dive a little bit more into performance, in particular, AB, talk about some funds underperforming the benchmark. I guess what you're doing is when you allocate money to your super, is that someone else has control over your financial well-being when it gets to retirement. What kind of performance would you expect and what results are we getting across the board, broad strokes here?
Look, we're in a trickier market than we have been for a few years. And again, we see a lot of posts on our social. My super's done really well over the last couple of years. Well, it should have. The market's been bottom left to top right chart. That's the time that is relatively easy to make money. And so your super fund should have done very, very well through that time frame. And we alluded to this at the start of the year with our outlook for 2022, that we expected 2022 to be a significantly more volatile year. It's not going to be a trending market. It's going to be a very choppy market. And as such, I'd suspect that a lot of those people that last year were pleased with the performance of their super, if they've looked, say, over the last quarter as an example, will be fairly disappointed to see the money that's been given back. And look, superannuation is a long-term game. You don't look at day-by-day trading performance on something that perhaps is a retirement horizon of 30 or 40 years' time for a lot of people. So it's easy to sort of not get caught up in the day-to-day or fairly short-term price moves or performance moves on your fund. However, it is something that you really should be looking at. And one of the things that we encourage all of our clients to do is that money date each month, where you evaluate the performance of how your money is working for you. Whether you've got your mortgage chipped down, whether if you've bought shares, they've gone up, how your investments have performed, your super, your managed fund. Have a look at that constant review and compare to what you would expect. And there's nothing wrong with having a bad few months or even a bad quarter or even a bad 6 months from time to time. But when it becomes sustained and it's continually underperforming, and I think it was at the Siemens or Maritime was one of the pension funds that did fairly significantly underperform the benchmark. You got to say, well, how long before you cut it and put your money somewhere else? And this quarter has certainly been a challenging one, I would think, for a lot of the big guys. And the interesting thing, because of the mandate for superannuation money, and I know there's some, my time in the UK, tends to be very slow moving, buy and hold core assets without that much activity within the fund. And that's very much the premise, because the time horizons are 10, 20, 30, 40 year time horizon that you're working to. That can be very, very expensive in the current market conditions. And if we take, for example, the volatility that we're seeing in markets as a consequence of Russia's invasion of Ukraine, our government has come out and said, like, if you're a funds manager, you have no business in holding assets in Russia. There's sanctions. It's time to liquidate, reduce those positions. And there have been companies like Aware Super, Rest, Cbus have all liquidated their Russian exposure, and rightly so. One of the laggards in there that have yet to move as we're recording this, and that may change over the next few days, maybe it won't, is say Australian Super. And Australian Super, look, it's huge. It's the biggest super fund in Australia, $245 billion. And they had about $300 million or so of exposure to Russia. And that portfolio would be worth a lot less now. I think, one of their holdings is down 137 million. Now, when you manage 245 billion, 137 million is tuppence halfpenny. It's not a lot of money. But if you're salary sacrificing or contributing 10% of your income to your super each and every year, 137 million is a lot of money because it's your money that you've worked hard for and needs to be put to work. And so they've got a holding in Sberbank, which is the largest bank in Russia. And effectively, it's worth a penny. It's down 95% or so now. And the question for Australian super is, look, our mandate has to be to operate in our members' best interest. So forcing us to sell something that's now worthless is going to crystallize this $200-300 million loss on our book, which will affect the performance of people's super. Now, on the moral side, you shouldn't be in Russia, but on the commercial side, you're kind of having to get out after the horse is bolted, which then, of course, bodes the question. That share price didn't drop in one day. It's actually been drifting down. It's down 90-odd% since the start of the year. It actually dropped 75% on Wednesday last week. So there was plenty of time to close that position, but there's no reason to, because from a sector perspective, industry, there's more money coming in. It's a 40-year mandate. Doesn't really matter too much. And that's not to say the investment managers don't take a fiduciary duty and an active pride in what they're doing, but it's very, very slow moving. And you've got to ask yourself, well, how are you still holding what was $137 million worth of shares in a company that's about to implode?
Regulatory risk, performance risk being two huge ones there, AB. Couldn't agree more.
Yeah.
For your average person, where do you then go? Self-managed super being another option, or retail super fund. So out of those two, which do you prefer, and what are the pros and cons?
Yeah, that's a big and very, very broad question. And I do think when you hear these sorts of things, and there'll be people listening to this go, oh, my super's gone, all right, go and actually have a look and see what it actually has done. And some of them have done very well, don't get me wrong. The primary question you got to ask yourself, who's got the most vested interest in your financial future? And it has to be you. You're the person that's working. It's your money. It's your retirement. Your savings going into it. Your employer's contribution going into it. So you've got a genuine, robust, vested interest in making sure you get the very best of that. And the trade-off is, okay, that's easy to leave it in a default industry super. I could do a little bit of paperwork and maybe be a bit more active in what I do and get involved with the management of it. And then you come down to those two areas. Is it self-managed super, or do you go into a retail super? Retail super, I think, typically is probably a little bit more keenly managed in terms of it's more of a competitive market space, as opposed to being a default. It's somewhere that people choose to go, as opposed to it's your default to go. So by its very nature, it's more Darwinian. So, you've got more aggression in terms of performance and a requirement to perform. Secondly, it's not that complex. Talk to your financial planner. We can certainly assist with that. Work out what your risk profile is. And these things all sound like big jobs, and they're actually very, very straightforward. It's a simple questionnaire. It'll assess your level of risk, and then you can pick a retail fund to divert your money into. You can roll your position out from your industry super and put it into something that maybe might perform a little bit better for you. More importantly, though, you've got more control over it, because you can switch between retail funds, and depending on the financial advisor or platform you're using, you don't have to pay switching fees, all that sort of stuff. So it doesn't have to be an expensive exercise. That's something that's probably suitable for people that have got smaller balances. And by smaller balances, it's always very hard when people will say, how much money do you need for a self-managed super? No one will come out and say, this is the number. Do you know something? I'll do that for you right now. If you've got less than $250,000, self-managed super probably is not the place for you when you look at the costs of running it versus what you're getting for your money. If you've got more than $250,000, you probably should be considering self-managed super on the basis, if you're interested in learning more about managing it and you want the responsibility that goes with that. So there's a number, 250 grand. You can search high and low on the internet. No one's going to do it. We play a very straight bet here. There's no behind the curtain. That's what the sort of default amount probably sits at. A little bit more, the better, but 250 is probably the minimum for it.
Okay, so talking specifically to those people in that camp, AB, who have a decent super balance and maybe are considering self-managed super, where do you go to get such advice in order to do that, and what are you actually doing?
Look, I mean, the online facilities for setting up now, they're making decisions to save money is not a good idea. It's always good to save your costs where you can, but sometimes you get what you pay for. And I've seen a lot of problems where people have gone down the online pathway, and don't get me wrong, there are some very good providers in the online space where they go, oh, it's only cost me this to set up. It's going to cost me double that, for example, if I go through a financial advisor. but then they found that they don't have any insurance in play, for example, or there's a significant deficiency in what they're doing. It's not what they thought they would. So pay the money, get the advice. Remember, we're talking about a long-term time horizon here. You're going to retire in 20, 30, 40 years' time. So whether you pay $1,500 or $5,000 to get your super set up, get it set up properly, because if you amortize that $5,000, let's say that's what it cost you, over the next 40 years, it's an inconsequential decision to have it set up in the right way. So I'd probably suggest full service for most people. If you're more sophisticated, and you think I can do this myself, if you're more sophisticated, that's all the more reason to lean on professional advice, particularly if you've got a decent balance in your super. As I say, the biggest deficiency I see when people try and do it on the cheap is they run into massive problems with their insurance. Massive. So don't get into that space because the consequences of it are vast. So, seek professional advice. Again, reach out to us. We've got a financial planning team. We can walk you through everything you need to. It's cost competitive, and you're going to be educated on what you're doing and why you're doing it. So, that's going down the self-managed pathway. Again, talking to a financial advisor, again, we can help with this. And going down a retail super pathway can give you the hands-off opportunity to be able to manage your super without the need to actually be doing the investment decisions. You're just simply choosing which fund to allocate your money to.
Got you. There's an interesting couple of pieces of comments in there from UAB. And I guess it's all the more reason to take control of your financial future is the lesson here.
It's your money, it's your future. You've got the most vested interest in doing a little bit of work now, whether that be down the self-managed pathway or going down a retail fund, has got the potential to pay significant dividends down the track. And what you think you may be in versus what you may be in aren't necessarily the same thing. And industry super has had a great run for a long, long time, being the default place for people to put their money in. Again, to caveat this, how we started, it is an important place too, because it means everyone has something in play. If you get the opportunity to move a little bit further along the line and learn a little bit more about investing and take your future and retirement prospects a little bit more seriously, there are lots of other avenues that you can look at. And when you hear of being charged an additional fee to provision for any potential fines from a regulator for misconduct by the management, then you got to ask yourself the question, is that really in your best interest? And I'm not so sure that's the case.
Well said, AB. Well explored here today. Industry fund, super risks. Thank you very much for your advice as always.
My pleasure. Anytime. There you have it, guys. Make sure you give us a review and a rating, and we'll look forward to hosting you next week.